All right, good morning everyone. Tim Hart here from Private Mortgages Australia. We are just about to start. We've just got a few people sort of trickling in, so we're just going to give them another sort of 30 seconds to sort of load up, and then we'll get started. So yeah, grab your tea or coffee or whatever you'd like. We'll probably go for about half an hour and just really go through where private lending's heading in 2019. Okay, great. Now it looks like most people have loaded up now, so we have a lot of people on it. This is a really hot topic at the moment, especially with everything that's happening with the Royal Commission aftermath, we're calling it. And what I want to do just to start off with is just run a little poll on when you think the banks are actually going to start lending again. So when are they actually going to start loosening up their credit and start lending like they used to investors and developers in particular. So so if you can just fill that out. So we've got a few people coming in here. Someone's gone with the never option. I don't know if that's true, but most people seem to be at the moment seems to be around that sort of 12-month mark. It's very interesting, and even quite a lot of people saying 6 months as well. So just keep those votes coming in, guys, as we go. It'd be nice to see where everyone sort of sees that it's going to happen, but it looks like most of it's going to be in that sort of 6 to 12 months sort of range. My personal opinion, I think 6 months is way too fast for most banks to sort of handle that their processes and get back into the space. Ultimately, what I think it might be that 12-month mark, and then it'll be a sort of a real easing back into the marketplace. And it really is going to come down to what's really happening in the marketplace. Our house price is going to continue to come back, in which case naturally they're going to start to pull back a little bit as well. So let's jump in. So what with private lending, and I said this is really the Royal Commission aftermath, is what we're seeing a lot of at the moment is the banks are starting to cut back on their broker channel. It's all the wrongdoing they did. It's almost like they're saying it was all the broker's fault, and how dare they charge all these fees when really it's everything to do with the banks. So we're seeing a massive cutback in the broker channel. There's a lot of talk about removing broker commissions and getting people to pay for being advice, like a financial advisor. Yeah, I think that's ultimately just going to hurt the industry, and probably those that need the advice from a mortgage broker the most aren't going to be able to get it, aren't going to be able to afford to it, and they're going to pay for it. When they go and get perhaps a loan that's not quite right for them. So that's what we're seeing a lot of. We're seeing a lot of increased regulation from ASIC and APRA. I mean, this has been around for a last good 12 months, where they've really been showed up that they've been almost asleep at the wheel. They haven't really done anything. They haven't done any enforcing. And so what I think we're seeing now, and what we're going to see more of, is that they're going to go the opposite and say, well, if you don't think we do anything, well, how about this? And they'll go in and we're seeing a lot of ASICs sent out a lot of information requests to all their AFSL license holders, requesting a lot of information from each of the schemes and where they're up to. So I do expect them to be a lot more aggressive in the marketplace, and that's obviously going to slow the banks down. No bank wants to be the test case, I guess, for them to really show how they're really enforcing their regulations into the marketplace. Another thing we've got here as well is the Sydney and Melbourne house prices. The house prices are cooling, and they're kind of expected to keep cooling as well. So naturally that is going to weigh on the bank's mind as well in terms of how aggressive they're going to be in the marketplace. The other question is around is interest rates as well. I mean, it almost seems to be every single day you see someone saying they're going to go up, another person saying they're going to go down. I think really we're not really going to see a lot of change, probably for the next 12 months, unless we see some catastrophe happen or something happens that's external. And ultimately, what this all leads to, and this whole, the Royal Banking Commission and all the changes that are happening, the banks are lending less. They're being forced to lend less. They don't want to lend as much, especially in falling markets. And that also exacerbates the issue of the cooling market as well. They start lending less, people can't afford to buy, therefore prices drop. So we're seeing a lot of banks also, if they are lending, it's usually done at much lower LVRs, and so that's what we're really seeing, and especially around investors and developers. If you're a developer trying to get finance in this market, I mean, it's just ridiculous. The banks are pretty much all but saying no, or very, very restrictive LVR requirements. So this, and what the plan is for, the plan for 2019 for PMA is really to increase our investor and development funding. So really taking up from where the banks are dropping off and where they're not servicing that need in the marketplace. And we're seeing a huge uptick in the amount of inquiry that we're getting in that space as well. And a lot of brokers that, perhaps haven't even heard of us private lending or even used us before are starting to come to us and say, look, 12 months ago, I could have got this through the bank, piece of cake. Whereas now I can't. And, my client really needs the funding to get their development underway. The other thing we're doing is, as the banks pull out of that broker channel, we want to, basically do the opposite, and we want to double down and go into that broker channel even more. We've always have a massive, resources allocated to our broker channel, and that's the simple fact of it is we get 95% of our business through brokers. Okay, so we want to make sure we look after our broker channel, and pay them and pay them well. So part of that is that we're taking on a lot more staff. We're really gearing up to be able to take on increased demand for funding. Something very, very exciting we've been working on for the last about 8 months now is getting onboarded with an institutional backer. So we're probably only about 2 weeks away from that. You'll see some stuff in the media that's going to allow us a lot more volume and a lot more sort of cheaper rates that we can do as we get access to that. The other part that we're investing more in our broker channel is around education. So on our website, privatemortgagesaustralia.com.au, we have a resources tab, and in there we've created I think it's about 18 different videos, and they're little, just a lot of them are just 1 minute, 2 minute little videos on different things to do with private lending, and usually in particular how it differs from mainstream traditional funding from a bank. So you might be you just want to know what's the difference between a coded and non-coded loan. Great, there's a little video in there that I step you through step by step exactly what's the difference. And even you can see one there, qualifying a transaction. So the steps that we go through. Now, a lot of these videos I'm going to cover in this webinar. I'm going to talk to you a little bit about how private lending works and how you can actually send things through to us and have a bit of a look. So let's get into the different types of products that we have. So with private mortgage, we're quite simple. We used to do caveat lending. We have dropped that now because we really want to focus on that first and second mortgage space. As I said, as we get more investors coming on board and we become institutionally backed, that's allowed us now to start doing first mortgages from 9% per annum. Previously, we were sort of at that 12% plus. We've been able to bring that down. And the other big change is that we can do loans up to $10 million now, whereas previously our limit was around that $2 million mark, and we couldn't really go above that. It was really done on a case-by-case basis. So it just allows us now to be able to do much bigger loans and service a much bigger portion of the market. The other thing we do that no bank in Australia does is second mortgage lending, and that includes mezzanine funding for developers as well, and that's got rates from 15% per annum, and we can do anything up to about $2 million. Now, the next thing I just wanted to cover here is the loan to value ratios, because probably one of the biggest questions we get asked is, well, Tim, how much will you lend my client? And so basically what we do, we break all the postcodes in Australia into 4 different categories. And this is based on the old Genworth financial postcode categories. So if you're not familiar with it, you've got category 1. Most residential properties are in category 1. So anything that's like 40 to 50 Ks of a major city, Melbourne, Sydney, Brisbane, that sort of thing is category 1. Category 2 is your more bigger regional towns that are a little bit further out, maybe slightly lower populations. Category 3 is your smaller towns. And then category 4 is affectionately known as whoop whoop, property that's in the middle of nowhere, probably maybe farming land. It might be really, really small towns. And you'll find that most banks won't lend on category 3 and 4. I mean, even a lot of private lenders don't do category 3 and 4. It's just too far out. And the prospect of trying to do a recovery in a regional setting is quite challenging as well. So whereas private mortgage, so we are happy to do lending. As you can see, we do slightly lower LVRs, but we do still do lending out there. Now, the other thing I want to point out here is we've got our maximum column. So as much as we say for category 1 residential properties, we do up to 75%. We actually have, internally, we have discretion to go up to 80%. Now, it has to be commercially justified. And one of the things we do internally is we employ a specialist analytics firm that will show us the high-level details of a suburb. And it just looks at the supply and demand of a suburb. And it can tell us with relatively good accuracy whether or not a suburb is going to be going up or down over the short to medium term. So if we can get a favourable, we call them TLRs or traffic light reports, and we can see a suburb is going to be trending up, then that we can use that to be able to go up to like an 80% LVR for the residential property. So really with private lending, it is all about flexibility. As much as we've got these hard limits, we have that flexibility to go above and beyond that, provided it can make commercial sense. Okay, so that's where we also really differ from a bank, is that flexibility of what we can do. Now, when it comes to the other part of private lending is really about speed. Okay, people are coming to us because we can not only do a deal that a bank can't, but we're going to be able to do it a lot quicker than a bank. Okay, we're not a bank that's going to take 4 to 6 to 8 weeks to come back with a no. A lot of time we're doing stuff within 1 to 2 weeks. Now that comes down to our streamlined process. So you can see here the initial thing that we do is we get you to submit an application form, or we allow you to fill in our quick app form. Now, if you see on your control panel there, we've got some handouts. So in the handouts, you'll see it's called Quick App, and it's literally a 2-page document. You don't need to sign anything. You don't need to print it out. It's an editable PDF. So you just put in the real high-level details of the transaction, and that's enough information for us to do our initial assessment and provide you with an indicative letter of offer. That'll give you what the rate's going to be, and it'll also, the client will then, if they're happy with it, will pay a small assessment fee. So we charge between $550 and $770 to assess a loan once it's been the terms have been accepted, and that's really just to cover our cost of doing searches and title checks and all that sort of thing. Once that's been accepted, we finish our due diligence, and we then go to formal letter of offer. Once the formal letter of offer has been executed, settlement usually occurs within 24 to 48 hours after that. Okay, so it's designed to be a very, very streamlined process, and to be able to give the customer some feedback very, very quickly. And often we'll see our indicative letter of offer. That usually we'll be able to do within similar sort of time frame, 24 to 48 hours after we receive the application form, we'll get back to you with an offer. So let's just go through a case study, because it's always nice to see one in practice. So this is just a recent one, and so the scenario was they were looking to purchase a development site, and they had a settlement as the 23rd of December. Now, if you've ever been, if you've ever been in broking for more than a minute, you'll know that Christmas time is very, very busy. It is without a doubt the busiest time of the year for private lending and usually lending in general. Everyone wants something finished before Christmas. So we actually got the application submitted to us on the 19th of December. I mean, you could imagine trying to take this to a bank to settle in 4 days, especially at that time of year. It just never would happen. So we got the application in the 19th. We got the letter of offer out, the indicative letter of offer out the same day. The client accepted it on the same day. We then issued the letter of offer the next day. The client accepted it on the same day, and we settled on time on the 23rd of December. So the purchase price was $535,000. We provided a first mortgage of 75% LVR. The interest rate was 17.4% per annum, and the term was 6 months. Okay, so you can see that it's a real, very, very streamlined process, and it was very quick, and we had a very, very happy client, and obviously our referrer as well was thrilled with the result that they got the site. They didn't lose the site, and obviously all the deposit they put down and all the profit as well. So let's look at the other loan fees and charges, because I find that most borrowers and even brokers in the marketplace, they get so fixated on the interest rate, it's not the full equation. So especially with private lending, you really need to start looking at what the other costs involved are. So pretty much the only other main fee that we charge is an approval fee. So, and that'll depend on the size of the loan. So obviously, the more they're looking to borrow, the smaller that percentage gets. Now, what's built into that approval fee is a referral fee to our referrer or broker. So let's say it was a $1.5 million loan. We would charge a 2.75% approval fee, of which we would pay 0.75 to our referrer. The fees we charge, which I've covered just before, is the assessment fee. So $550 to $770, just based on the complexity of the transaction. Any legal fees or valuations, quantity surveyors, any other cost that we need is always done at cost on a flow-through basis. Okay, so we don't make any margin, no profit. It's whatever we get charged, we pass on to the borrower. And the other thing is that our referral fees are channel agnostic. Okay, so and the reason that this is that it doesn't matter if a borrower comes to us directly or they go through yourself as a broker or a referrer. The approval fee is going to be the same. Okay, so it's built in. That's why we build the referral fee into our approval fee. So that way there's no benefit from your client coming to us directly as opposed to going through yourself. Now, the other way that we work with referrers is that we allow our referrers to actually set their own service fee, or you can mandate your client directly. So let's say you part of the loan, it's $1.5 million loan. You're going to get 0.75% as your share of the approval fee. But let's say it's quite a complex development deal. Then you might say, look, I want to make an extra $1,000, $2,000 as a service fee, and we just put that into the letter of offer for you. So that way you can almost dictate how much you want to make on the transaction. I mean, of course, the client has to approve it as well, but it's all very transparent. It's all on the letter of offer exactly who's getting what. The other thing that we do to look after our referrers is that we pay subsequent referral fees even if the client comes direct. Now, I don't know of any other lender in the marketplace that does this, but if you send us John Smith and he has a loan with us and he has a great experience and it gets paid back, if he then comes to us directly and says, "Hey, PMA, we want to do another loan," we will do the loan. We'll do all the work. We'll take the client from start to finish. And we'll still pay you as the referrer your share of the approval fee. Okay, so, and that's actually a bit of fun for us because it's sometimes nice to be able to, call up one of your referrers and say, hey, we've just lent some more money to John Smith. Can you send us an invoice for $2,000 as you didn't have to do any work for it, but we ultimately see that John Smith is your client and we want to reward you and thank you for bringing them to us in the first place and know that we're always going to look after you for bringing that client to us in the first place. Now, the only time that we wouldn't do that is if John Smith was referred by a new broker or a second broker. So we're only going to pay one referral fee out. But if it's just them coming direct by themselves, then you'll get paid. The other thing we do is we have our own referrer rewards program. Now, basically what this is in addition to all the fees that we pay through, is we send you out gift cards. So as you hit key milestones, you'll get sent out a little surprise. You'll get a little gift card. It might be a Dan Murphy's card or a Flight Centre card. So it's just another way that we reward our referrers, bit of a mouthful. So you can expect to see that as you send more loan volume through Private Mortgages Australia. So just this screen here we've got is some of our specialties. So some of the things, not an exhaustive list, but some of the things that we do that a lot of other players in the marketplace and especially banks usually don't do. So the first big one is obviously urgent funding, which I've spoken about. You know, we a lot of the time we're doing stuff within a couple of weeks. They're not all usually as quick as 4 days, but yeah, they can be. But most of the time, yeah, 1 to 2 weeks is very, very doable. Another big one, development funding. You know, we do first, seconds, we do construction, you know, with drawdowns and interest capitalization allowances, and, you know, the whole gamut is what we do. It's not just full settlement at settlement. Asset lending, and this is quite a big one for us, is that, you know, we're more interested in lending against the asset as opposed to looking at the serviceability of the client. So for us, because serviceability is not required, that's a real benefit for a lot of our borrowers, that they can't show serviceability. That's fine. It's what we're more focused on is what's the client's exit strategy. How are they going to repay this loan in 6 months, 12 months, whether it be a refinance or the sale of an asset or something like that. Something else we do is ATO debts. So most banks will not lend to someone who has an outstanding ATO debt or an outstanding ATO portal, and whereas we can come in and actually pay out that ATO debt with a loan, and once they've then got a clear ATO portal, it makes it much easier for them to go and get more traditional funding. We've also done a lot of refinancing existing caveat loans. So, you know, a client might go and get a caveat loan, and we've seen some very, very high interest rate caveat loans. And once they go into default, you know, we've seen default interest rates of like 15% per month, where we can come in and basically refinance that loan out to a much cheaper, maybe second mortgage, at much, much more reasonable rates. Something else we've done is valuation, not contract price. So we'll actually lend on the higher of valuation or contract, not the lesser of. So we've done loans before where we've lent over 100% of contract price, because we live in the real world, and we know that you can buy a property under market value, or you can add value before you need to settle that property. So we're not shy of lending, you know, higher than what the client has actually paid on the contract, provided it values up. Other things we've seen, paying out business partners, urgent business opportunities that client needs funding for. And the last one I'll mention as well is credit impaired, okay? Because as you know, most banks, if you've got any credit issues, then, you know, pretty much forget it. Whereas credit's not so much an issue for us, because we're more asset lenders, we're more focused on what the security is, as opposed to, you know, the serviceability and credit of the borrower. Now, the only time that we might, that credit might come and be an issue for us is if the client's exit strategy is to refinance with a mainstream bank. Then of course we want to make sure we're setting the client up for success. That if they've got credit issues, we know that's going to be an issue for the bank. Therefore, that might be an issue for that exit strategy. So that's the only time that it might come into play. So just to sort of finish up here, I just want to talk about the PMA way. And our real tagline is all about cleaner loans, better results. So part of that process is we have low upfront assessment fees. Okay, so it's basically just covering our costs to do our searches. We want to make our money when we lend money, not by just looking at applications. Part Part of this as well, we have no charging clauses or cancellation fees in our indicative letter of offer. So the client can sign it. If they then change their mind, they get a better offer, they win lotto or whatever happens, there's no extra cost that they need to pay. Any valuations are always done at cost, and they're also done at a reasonable value. We've seen other lenders in the marketplace that will get a valuation and they might charge more than the valuer is charging to get it, but also that the valuation is being done for maybe a forced sale, which is never going to give you the true value of that property. They're basically asking the valuer, work out what it's worth and then, take 20% off the price. So when the valuation comes back and the deal doesn't stack up, the firm can just say, great, we're just going to keep your upfront fees and thanks for coming. It doesn't happen a lot, but we have seen a bit of it. So we want to make sure that we're doing it, for market value or for mortgage purposes, not for a forced sale. As I said, legal fees are always done at cost. We also rebate any unused interest on extension payments. So if a client makes an extension payment to extend the facility for 1 month, and then 1 week later they refinance and pay us out, we refund the extra 3 weeks that they didn't use. Okay. The only time we won't rebate interest is on the prepaid loan term. So if the client has a prepaid loan for 3 months, they're paying that money if they pay it back after 1 day or 3 months. Because it's just, if they paid it after 1 day, there would be no money in it for us. So that's why we make sure that those prepaid terms are fixed in. Now, the other thing we've got is custom-built software that we've worked on in the background that enables us to do these faster deal processing times, so that when you come to us, you know that it's on track and that we're working with the customer to hit a deadline. So if you have a client that says, "Hey, we need to settle by next week," then great, let's work on how we can make that happen, as opposed to a bank that just goes into the sausage machine and it's ready when it's ready kind of thing. We have a very hands-on approach with our borrowers, and we like to work with them to make sure that we're going to get them a solution that's going to work. And what that means is what we get and what we've been around for nearly 5 years now. We have a very, very high level of repeat customers because they have a great experience with us, and they want to come back time and time again. And so for us, that's how we know we're doing well. And that's how we know we're hitting our mandate of a win-win approach to lending. So I hope that's been informative, and it's going to be a very, very exciting year ahead with private lending and just seeing what happens with the banks and what unfolds. That it's going to be a very, very big, I believe, in the next couple of years in that private lending space, and we really hope to be helping and working with a lot of you to help those clients that the banks just simply aren't servicing. So if you've got a particular loan scenario that you want to run past us, please contact our Senior Relationship Manager, Shanta. That's what she does all day long is look at scenarios and send out offers. So you've got a direct number there, as well as her direct email. As I've mentioned before, we've got our website there. Please go on and have a look at the resources section, and make sure that you download the handout that we've got as well. You've got that quick app form. That quick app, that 2-page quick app, is also in that resources tab on our website as well. So thank you everyone for coming on board. I hope you've found that useful, and we look forward to hearing from you soon. Thanks.